Thank you. I'd like to introduce our chair of the next panel, and I'll let her in kind introduce her panelists other than naming who they are, because we did have a change in the program. Katinka Wallstrm is Senior Managing Director at Accenture. She has more than 25 years of experience consulting to some of the world's largest universal banks. She's a member of the Accenture Global Leadership Committee, leads various mentoring, diversity, and civic initiatives. She's on the board of the New York City Ballet. I think it's all Balanchine this week, isn't it? And great to have you here, Katinka. Thank you. With her on the panel is Adena Friedman, President and CEO of NASDAQ, Brian Moynihan, Chairman of the Board and CEO of Bank of America, and Gary Gensler, who is not on your program, but is former Chairman of the Commodities Future Trading Commission, and now a beloved senior lecturer at MIT. So Katinka, please.
Thank you. So we have a very esteemed panel here today. Thank you all for being here. My role is simply to try to guide this discussion with Adena, Brian, and Gary on this very broad topic that we have. What does this mean for financial services? So we're going to try to narrow the scope a little bit, and we're going to focus in on 4 areas. So as we think about all these new technologies in financial services, what's the impact on business growth and business opportunities? What's the impact on the client experience? What's the impact on the financial services workforce? And then finally, what's the impact on society at large? So we have a very broad topic, an excellent panel, and not too many minutes. So we're going to get started. So let me start with the opportunities, the business opportunities that all these new technologies bring. And Brian, I'm going to start with you. Bank of America has invested significantly in technology initiatives to bring new capabilities to your clients. So I have to start by asking you about Erica, Bank of America, because not everyone might have met Erica yet. And so if you want to tell us a bit more about this voice activated, sure, intelligent agent.
Yeah, I think Katinka, Erica is our voice activated, but it's artificial intelligence driven tool to work on our mobile banking platform inside the app. So if you go in and log in, if you just go in and log in, say pay Brian $5, and if you have my cell phone number, it'll pay me $5, so you can all try that.
Now.
And it does work. But it's interesting because the real interesting part of voice recognition combined with artificial intelligence is allowing people to speak what they want and having it come out the other side. And yet it's a lot more difficult than people think, because and this is where this technology gets interesting, is that one of the things we had to do is create a new natural language dictionary, because if you ask the question, what's my balance, you might get a yoga class, you might get a thing. So we had to go out and we worked with one of the competitors to the universities here to build that for us. And so it took, so you think about these technologies, which are not hard to think through, like voice recognition, but applying them in banking, applying them for artificial intelligence, having the network connectivity that allows us to, somebody 60 miles an hour in a car, 70 miles an hour in a car, talking to the phone and having it understand them and come back to them, hopefully as a passenger. And you start thinking about all the things to do, and then all the data and distributing. But we got 40,000 teammates have been up on it for about a year. It's going out in some states now. The people love it. They use it for all different things. It's the BFF of a lot of people that they tell us and things like that. But it's really gearing, and it does certain tasks, but really what was scrolling through a digital, very sophisticated mobile platform and finding things, you just say it now and it pops up. So all my recurring payments pops up. Think about how much easier that is for the customer. But the technology behind it is a lot of things coming together. And then executing behind that is a lot more things coming together. So we're really proud of it. It's 3-4 years in the making, and it's out there, and we'll learn from it. The other thing is how people use it today versus tomorrow in the future will be interesting to see.
Yeah. No, it's a great example. So NASDAQ is certainly a technology company as well. And we all understand that blockchain can bring incredible efficiencies to capital markets, but it still feels kind of new. So at NASDAQ, can you tell us a bit about real applications for blockchain right now, or perhaps things that you're thinking about in the near future as opposed to 5 years from now?
Yeah, sure. Well, I do think that the blockchain was a technology obviously uncovered through the creation of the cryptocurrencies, but the fact is the blockchain, that technology layer underneath it, has a lot of other applications and a lot of opportunity. At first, though, I think it was kind of a solution looking for a problem. And so then it's a matter of working with customers to really find those problems that can be solved with this kind of distributed ledger technology. And the promise, the long-term promise of the blockchain is the concept of creating a lot more efficiency in the capital markets in terms of time to settlement, so that you can take capital out of the system and apply that capital back into the markets and create more liquidity in the markets, as opposed to having it captured inside clearinghouses and other places where it can't be used. So that is the long-term opportunity. In the short term, though, I think the reason why that is a longer-term goal is that I call it it takes a village software, or technology, I should say, meaning it's the easiest part of the implementation is actually at the exchange level. We can go ahead and implement a blockchain-enabled market end-to-end from pre-trade risk management through to settlement today. But it's the network of all of the users and all of the clients and all of their back office systems and all of their settlement processes that have to change in order for it to be actually usable in the more mainstream markets that exist today. So where we've been applying the blockchain early on is we actually are implementing the blockchain for proxy voting in South Africa today with the South African CSD. So they now have a perfect record of beneficial ownership of all of the shares, so that they can then have a much more auditable record of proxy voting. And have it all be automated. Another area that we're focusing on is fund administration in the Nordics, because a lot of the Nordic banks have come together, and we're basically applying the technology to streamline the creation and administration of mutual funds, which today is actually quite paper-based. So it's a good example where it's extremely inefficient today, and you can kind of take it into the next generation. And then the third area that we're exploring with our bank partners in our clearinghouse in the Nordics is collateral management through the blockchain. So those are doable things that we're working on today with our clients, and then a specific implementation that we're underway with in South Africa.
Right. So Gary, coming to you and thinking about all these technologies, so certainly robo-advisors, blockchain, but then there's cryptos, there's machine learning, cloud, there's no shortage of new technologies. So again, thinking about the theme of financial services, do you think some of these technologies are more applicable now as opposed to, again, 5 years from now?
I do. I want to first say that I think that the world of finance has always relied upon technology. I mean, from the first telephones going onto the floor of the New York Stock Exchange, or even the telegraph in the 19th century. But the last 40 years, it's the acceleration that Brian's firm and Adena's firm aren't Facebook and Google, but they're looking a lot like Facebook and Google more and more, because you really are technology companies. I think the near term, customer engagement, like your product, it's called Erica. But it might not be your product. It might be like a mobile app company called Robinhood. Or it might be that Telegram then puts something on top of their messaging app. And I think that that's going to be the disruptors are really, the way they're getting in is more about the mobile experience and the client experience. But I do think two other areas near term. One is machine learning, which is sort of the foundational level where AI, artificial intelligence, is on top of machine learning. But there's so much data. There's so much information inside of a NASDAQ or of a Bank of America. It's using the machine learning primarily in the capital markets. You're already using that. You have a big analytics part. I want to say a third thing, and it's about the crypto space. I think blockchain is very much at the early stage, and it will make changes 10 and 15 years from now, maybe, but not in the near term. But there is a $400 billion market capitalized business called crypto. And one exchange, Coinbase, has 13 million customers here in the US. And so I think that near term, I would prefer to get inside the public policy framework. I think there's a lot of activity that's illicit activity and ill-gotten gains and front running and market manipulation, a lot of bad stuff. It would be better to come inside of some public policy framework, but I think that will happen, and the NASDAQs and the intercontinental exchanges and others will probably get into this space in the next 12 to 18 months. That's just my prediction.
So we're going to come back to the bad stuff in a bit, but let's stay on the good stuff for a while. So you mentioned that probably the most benefit right now might be around client experience and digital, and just seeing how many users all the banks now have that are digital users. So Brian, on that, we also know that most industries, their customers are bombarded with content that actually they don't want. So as you think about personalizing the experience that your clients have, say they want to do an auto loan or a mortgage application, how are you thinking about that in that kind of better experience mood?
Well, a little bit what Gary is saying and Adena was saying is it's an integrated experience. So even though we have 1,200 branch equivalents of checks deposited on a given day through the mobile device, it's still 26% of the checks. So there's 74% that go on elsewhere, about 50 percentage points of that goes on the ATM and the rest over the teller. And so we still have 1 million people. There's 875,000 people come in every day to the branches. So it's how to integrate that. And so the client experience that Gary was talking about is how do you have somebody walk in a branch and you have an ability that we do to activate them and know everything that's sort of gone on with them in terms of maybe there's an offer made or maybe there was a problem before and they have instant access. That's done so much easier with the tablet technology we have in the branches and distribution of the data and the ability to analyze it that you can actually see all that. So it's been pretty good. Now you take it to the next question. So we sell about 25 to 30% of our sales are digital in the consumer bank now. That's multiples over the average bank, but it's also multiples over retail sales. And so we've been driving at that, and recently, as you mentioned, we've had a couple things. So we just launched the mortgage product, which is all digital for our customers that we can pre-populate, save about 80% of the paperwork. Not for prospects, because you don't have it. Somebody's got to put the information in, but for the people we have, we can pull a lot of that out of our systems, going to Gary's point. And on the auto side, same thing, is you can shop for 2,000 dealers' cars on our site, find a car, a specific car. So if you want a Prius, you can find that Prius in that color at that dealership, and then go to that dealership. And while you're doing that, we're underwriting your auto loan, and you can go in and be financed. And so it all happens digitally. And so, but it's really the combination of the shopping experience with the thing. So we're working on all this stuff, and those things are really out. Like one of them's out like in the last couple of weeks. The other one's been out for about a year in different markets, and you're seeing it build up. We're getting 7 times the application out of business on a relative basis to the markets. We've had it in there for 6, 9, 12 months. So they're very good. It's just, you still have to be able, when that person walks in the dealership, buys a car, to work with that dealer to finance them too. Mm-hmm. And that's going to be years to change, and part of it's just because people are people, and they come about things differently. And so, but it's all the things that Gary was talking about in terms of that data and that analytics and distributing and understanding it and underwriting based on it. And done in a very customer-centric way, and we're pretty proud of this stuff now. But we're still in the early days. Where it will go, people always ask. I don't know. We'll see.
So that's kind of the client experience, and then of course we have the workforce experience. And we were talking about this before, and you were mentioning that financial services has always been heavy technology users. So I think some of us remember when ATMs were introduced, and that was there was quite a debate at that time. And would it take work away and destroy, the work of the banker? And what we found was that sure, some of the more transactional activities went away, but actually the bankers, the tellers, became more focused on customer service and sales. And of course, the exchanges. We went for open outcry to electronic trading. So is this, Gary, just another trend? Is it a revolution? Is it an evolution? Do you think it's that different from what we've seen before?
I think it's a bit of both. I think it's more evolutionary than revolutionary. I think large financial institutions will be around for quite some time. Your workforce might be less than, what, about 300,000 now?
We're down to 209.
209. So I think that in many areas, trading floors have become quite more electronic and so forth, that you could have smaller workforces. Mm-hmm. The back office, for sure, as Adena said. I think that the reconciling and clearing and settlement process could be smaller. But there's one thing. I think we humans still want advice at some point. Over our life cycle, at some point, how do we save for retirement? What do we think? You know, there's still things that we want advice. And those millennials in the room that are tapping away at your phones and everything, at some point you'll want to talk to somebody. But I do think the workforce is that NASDAQ and Bank of America and like might have smaller workforces, and then people will get their services. That's called efficiency.
Well, I mean, I would say I think that there's definitely going to be a shift in the skill base that people are going to be looking for in the financial industry. And I do agree that on the back office side and some of the really repetitive areas, I think that there will be an opportunity to automate some of that. But what we also see is, I usually say that I think that the artificial intelligence or machine learning is going to be able to handle greater and greater complexity, right? But there's still this issue of creativity and judgment. And so I do think that the human brain still is, you know, will be the home to creativity and judgment for many years, you know, hopefully many decades to come. So that blending of man and machine in the markets, whether it's in the capital markets, in the retail space, I think that idea of allowing for machines to handle more and more complexity in terms of trading strategies, investing strategies, but then also having that human judgment and creativity to look at the human element of a company, you know, and the human element of designing and providing advice to a person as they're going through their life and making sure that they're thinking about their future and planning for it appropriately. So I like that idea of the blending, but I do think the skill base will change. So if you look at I guess the markets, for instance, there were a lot of people sitting on the floors and, you know, throwing papers around and doing, you know, kind of having that role. A lot of that role has been moved to machine, but now we have a growing workforce, not a shrinking one, around technology, right? In terms of hiring programmers, hiring engineers, and making it so that we're making progress in terms of developing and implementing more technology in the market, including our surveillance technology, which actually does oversee, you know, about 150 broker-dealers, 50 exchanges, and 12 regulators all use the same underlying technology that we can then apply machine intelligence to. And in fact, one of the crypto exchanges has in fact starting to use it because of what you just said.
When you look at this, so one of the challenges around large organizations, how you're driving those kinds of application of technology, not applications, but application of technology. And so, you know, everybody, you know, people will reach out and say, you know, on some day we need there'll be no, you know, one job left because all the job, it'll be out there a long way and it may never happen. But the reality is you're looking for ways to do it, and it's interesting. So we have, I don't know, 80, 90 blockchain patents already. We have a lot to go. We're finding in some places it's actually less efficient than the current methodologies and ways it work. Some places it's going to be better. You know, and so these will take a time to shake out. So everybody, I think, we're all worried about this as societal participants. But like anything else, there has been a massive change in technology application in any industry, including ours. You've seen massive changes in what people do, and that will continue. And there's some things here that might make it happen faster. But at the end of the day, it's going to take a good while. And so we, just like AML KYC, we have this bot. We developed a bot to pre-fill, you know, a lot of the data. It saves, you know, a lot of time, and it didn't take much to do. It's not going to massively change how we analyze. We've been using artificial intelligence is what we call it today, but we've been using it for years. It's how we built the program. But the mundane task of loading the information off 10K filings into the database to pick up and analyzing populate, you can watch it, and you just watch the thing go do the work, and you're saying, there's nobody doing this. It's just going off and doing it, pulling it from the SEC database. Those are all great things. It costs $500,000 to develop it. It saves a lot of people over time. But it's going to be more micro application, I think, for a while.
But you still need people to analyze the information
and
and come to the judgment as to, right, exactly.
There's actually, Peter Drucker wrote an article a long time ago that basically said, with the advent of the computer, there will be no reason to have management. And he wrote that in the mid, I think it was late 80s, probably late 80s after a big
but I'd say this.
And you sort of look at it and say, has it happened? No.
The financial services sector is about 7% of our economy. I mean, it's the essential plumbing, and it has been for centuries, but it's essential plumbing. But it's not 7% of the workforce. I mean, it's already, in a sense, taken technology and been efficient. And I heard that Accenture, you said, it has 440,000 employees?
Globally.
So globally, a global consulting firm has twice the employee population. So maybe
'cause
the
they
jobs
charge
that were
more than
there
we do.
will go somewhere else.
Sorry. But actually, there's an interesting point there, Gary. I agree with you. It's that the labor content will be, the interesting question is where does that bar get set? That's what's being challenged. This is what Peter said many years ago about management. It's true, the information flow doesn't need people involved. It can come up to the surface. So, but it's not going to be an overnight, but it is changing the human being content relative to the total output. That's a given. But, and as Adena is saying, but you're redeploying that. Our investment in technology development is $3 billion a year, so we're redeploying, that's probably doubled over the last 6, 8, 10 years. We've redeployed a lot of that back into that, and so we've got to train people to be ready to do those jobs, and that's kind of the trick to it.
Yeah. So on that hybrid model that Adena mentioned, so we did a study on the millennials, as one does, and 2/3 of them want to have computer-based, automated, basically, investment advice as part of their base service with their banks. But then, of course, they also want access to humans, to experienced financial advisors. So as I look at Bank of America, I know that both your financial centers are growing and your digital user base. So you're already living in a hybrid model. What are the robots doing? What are the humans doing? How do you think of all that kind of coming together?
I think I never use the word robo-advisor because I think it doesn't do justice to the sophistication of the team that does things, but they use the automated tools. So an automated rebalancing, consistent investment account that's rebalancing every day, that's a computer tool that helps. But to Gary's point earlier, at some point, someone's got to sit with those people and say, what are your goals and how do you do it? They can actually pre-populate that today. That goes on today, guided investing, and they can pre-populate. We find that there's still tremendous value in having somebody use the tool in conjunction with the client or for the client to help them make sure that they're thinking through all the permutations, because, and that'll get better over time, and then you make the advisors more efficient, so they're spending less time on routine tasks and more time on that advice piece. But you're going to need both and not rely on either one, because you're going to need the technology to be effective and have the advisors be more effective, but you need advisors actually to put those layers on top that only they can do. The EQ that's required to help somebody plan their legacy or their future or what's really important to them is very hard to get the machine to read still. Maybe someday, but I think right now it's very difficult.
Yeah, which kind of leads to that question about, do you need to reskill the workforce? Is it moving quickly? So in this survey too, we asked top executives if they were going to use AI over the next 3 years and to what extent and doing what. So in terms of process automation, 3/4 said absolutely we're going to use AI to a large extent or a very large extent. Then we asked the question of, so are you investing in more training and reskilling? And only 3% said, yes, we're investing more than we're doing today. So is it that easy to learn these new technologies, or are we missing something? So Adena, I don't know, as you think about reskilling your workforce, are you looking at that differently than historically you have?
Well, I think that, first of all, NASDAQ has been a technology company for its entire existence, so we're not having to suddenly shift into something vastly different. But when we do bring in new technologies like, I would say, blockchain and machine intelligence, it's a combination of bringing in some new talent, but then retraining the existing technology talent to be able to work with the technology or to become evangelists for the technology. So particularly with blockchain, we've basically had a few, very small number of new experts that have come in. And then they basically have trained up the existing team, the engineering team, the development team, and the business teams to be able to offer those solutions out to our clients. When it comes to machine intelligence, though, and AI, I think that that's where you have to really focus in on a data science capability. And that usually does require a specialized skill that you end up bringing in the door. We already had some in our door, but I would say that that's probably more of a talent acquisition skill. And then you bring them into the overall engineering organization. So we don't have as much of a drastic change, but that's where we've been focusing on both in-house versus out-of-house.
So Gary, thinking about this from a university perspective, how are universities going to help us all reskill and get people ready for the next decade and beyond? And how do organizations work more closely with the universities, perhaps, if reskilling is required?
Well, universities are part of the solution. I think society as a whole, and we've done this well in our country, but never do we do it as well enough. is adopting technologies and then finding a labor force getting an opportunity to reskill. But the challenge is that not everybody can learn the AI. At MIT, there's a remarkable group of people that are doing artificial intelligence and big data and blockchain. And yes, we even have, sorry, Brian, we even have a couple of Bitcoin core developers. I know. But we're on the cutting edge at MIT.
Your power bills are going up then.
What's that?
Your power bills are going up then.
Yeah. And so what can the academy and the universities do is to work with those who want to come back, and whether it's through actually being at the university or through MOOCs, it's widely available lectures and the like. We have a role to play as well, but I think it's a broader societal role that we invest in education, we invest in retraining, and we make sure that we really have a fluid labor force, that maybe somebody that worked there can work there one day.
I think when I talk to the colleagues that run, like Adena and I run these companies and think about it, you are thinking about this issue of how do you drive this over time to end up where you want to go. You could describe it and understand it. You're using retirements, attrition, and who you hire new and everything to manage the human being impact of it. And then when you go to the groups we sit on around the country, this is the topic. In the last 48 hours, I've been in 3 conversations with different groups of CEOs and other outsiders about this question of how do you continue to arrange the education process to end up where we want, not necessarily at the MIT endpoint level, but all the way through, to have higher and higher skills pushed into high school level curricula or community college level curricula, because a lot of these skills that used to take a 4-year degree and traditional computer science training, you can actually push into different things. So this is going to take some short-term stuff, and really at Bank of America, we literally retrain developers from development tools of the past to development tools of the future. And you can do it, take 6 months. It's majorly worth the investment. We do that. But if you think about it over time, there's a series of initiatives that a lot of different groups around the country are working on in different cities and stuff, trying to figure out sort of this continuum from sort of middle school on to end up with high-level manufacturing, to end up with advancing potentially the training level that can be achieved in college, how community colleges fit in. So there's not like people are saying this isn't something we need to work on. And then we're trying to line up our needs to these groups so we can say we can employ 400 of those or 300 of those or 200 of those. And colleagues of mine in Charlotte, for example, out in the future to say, so if you train these people, we'll guarantee they'll have a place. And that's what companies need to do to help make this transition happen. So, but it takes 18, 20 years to grow a 20-year-old, 18 to 20-year-old. You can't make it happen overnight. So you have to be patient for this transition.
Yeah, but there's also a transition in terms of whether it's at the community college level or at an MIT.
Exactly.
It's just the society at large, and this is a challenge we've had for a couple centuries, and I think it's a good challenge.
Yeah. So let's get into the impact on society of these new technologies from a financial services perspective. So, Brian, I know Bank of America is, I think, the founding donor of the Council of Responsible Use of Artificial Intelligence. Right. And you've spoken very publicly about responsible AI, including in Davos recently. So why is this so important for Bank of America, and why should it be important for every CEO in financial services?
I don't think I'm allowed to name the university down up the Charles River from MIT that we did this with, but most people could probably figure that out. But we did it. You really have the questions of data and the usage of the analytical tools and the outcomes, and how do you make sure things don't happen, and the ethics of the use of it, where you can use it, where you cannot, the privacy implications. So the center is meant to start to just, as the center does at MIT, is to push the questions out there as only an academic institute can. Because it's hard, because it always looks like everybody's talking to trade, and there's a parlance that we all play in. But the reality is that the university setting, the convening power of Harvard in that case, or MIT, or Stanford, or others are getting in this, the convening power of these universities to bring people together to think through the near-term and long-term public policy implications, and hopefully develop thought process that can be put into a legislative or global legislative processes. That's what we're after. And it's also just the ways raise the awareness, even in the consumer level, of what they've agreed to or not agreed to and how to think it through. So there's no, it's really, we're very proud that we're starting the funding at the Kennedy School with this. But it's really to push it into that academic, open debate, courageous debate. Let's have a different point of view and discuss it, to try to form the policy of the future. And we got to get after it now, because this stuff's coming at us every day.
We've been working through the MIT Media Lab with the Harvard Kennedy School's Berkman Center on really an ethics and governance of artificial intelligence. And there's AI, I still think, is kind of years in, but there's still already issues like credit reporting, your FICO score. The more machine learning, the more artificial intelligence in there, what some academic research has shown, there's some biases. Yeah. And nobody even wanted these biases. They just sort of creep in because when you review data, all of a sudden, these FICO scores become biased against certain populations. And so then how do you clean that up? How do you sort of write the...
But also, just to follow that through, this is where the policy becomes, because if you think about then back testing discrimination, you have some research, but you actually have many, many years of FICO being a way that people determine that you then can prove that you weren't making a decision based on. And that's the thing, is that these things have to ferret out. So the Media Labs group and the Kennedy School and many others. And you need a lot of people to talk about, because there are very near-term things you're going to have to, in order to change that thing at FICO, you're going to have to agree there's a different standard for litigation by either agencies or not, and there's 50 states, and there's a federal government, and then there's a court system. This is not an easy thing to do. If it were easy, we would have been making these changes as we went along. So I think, but the only way to get there is to actually have the informed debate about it and have people actually talk about the plus and minus and try to see what's out there in the future.
So Adena, how do you think about this in terms of responsible AI?
Well, I do actually think that we look at it, I have a lens through the capital markets, and obviously the use of technology into the capital markets can be, the more sophisticated the technology becomes, the more that bad actors could come in and try to do things that are inappropriate in the capital markets. So we've been really focused on it specifically around using artificial intelligence and machine learning to make sure we're protecting the markets. And so the sophistication of those that are in a protection mode need to be better than the sophistication of those that are trying to come into the markets inappropriately. And that's where I think that we play an important role because of the surveillance technology we have, but it's also a partnership with all of the participants to make sure that we're really thinking through all the ways that I think the financial services community needs to have a little bit more of a push towards how can these things really, what are all the scenarios that could exist that could make it so that as new technologies come online, where you could see nefarious behavior start to creep into the system so that we are properly protecting the markets, protecting investors along the way. I do think it's the role of the regulators to get involved. There are these international organizations like IOSCO and others that could also play a role. But I think it's also just a matter of us talking to each other and then looking at all those technologies. We have been, we're very focused on looking at the next generation of technology and understanding how we can apply it in so that we can kind of introduce those protections before the behavior starts to develop.
Yeah. So Gary, I have to ask you about cryptos.
Crypto.
One of your favorite topics. And as we think about regulatory frameworks, I know you've talked about this quite a bit. So tell us a bit about what's going on. So
we now have a marketplace worldwide that has about $400 billion of valuation. Only about 40% of that is Bitcoin, just to give you a sense. So there's nearly 2,000 tokens. This word token just means a digital way to move code or data on the internet. And the blockchain technology allows that. But what we have is we have venture capitalists and we have really a lot of enthusiasm. Is this a new way to raise money? And last year, $6 billion was raised in a mechanism called initial coin offerings. It sure sounds a lot like an initial public offering. IPO became ICO. And that was a 40-fold increase, and just in the first quarter of this year, $6.5 billion was raised. So I think this year there'll be probably 20 to 40 billion raised, which is actually more than some early stage VC venture capital raised. So it's a significant part of the market, and about 200 exchanges are now. And largely it's off the grid. Many regulators around the globe are bringing it into money transmission regulation, but I don't think that's enough. Money transmission's about protecting against like money laundering and the like. And so I feel quite, that now's the time to bring this into a public policy envelope. It's just as relevant to protect investors. It's just as relevant to protect market integrity in this new technology as it is in traditional securities. These are, by and large, investment securities. Maybe even some of the biggest ones like Ripple and Ether that some of you may have heard about. And so I think the Securities and Exchange Commission under Jay Clayton's leadership is leaning into this and trying to get his hands around it, and his commission is by and large, has a very interesting year. But it needs to be done, and it needs to be done around the globe. And then incumbents, by the way, are, in a sense, it's an unlevel playing field. The incumbents right now can't strategically be sort of saying, I'll beg for forgiveness later. Incumbents always have to sort of ask for permission, that age-old thing. But the startups are all saying, maybe I'll beg for forgiveness later, or worse, they'll never catch me. And so it's just right now. We're not in the right place.
Yeah. So Adena, you must be evaluating this too and watching the space closely.
Yeah, I actually distinguish ICOs from cryptocurrencies. I kind of look at, I know that they use a crypto token to, as the basis of the ICO, but I personally feel that ICOs are securities. They should be subject to securities laws. I think the SEC is I think they are doing a very good job of starting to act on it proactively and taking a pretty aggressive stance. But you're right that there's still a lot of money being raised in this world where average investors are buying into something they don't understand because they don't have proper disclosures around it, and they're not getting an actual equity interest. They're getting a promissory note of some sort of future payment if the company or the construct ends up resulting in some sort of profit. And to me, that sounds a lot like an equity, but without the rights and privileges of an equity and without the protections that investors should have around it. And when average people and average savers are putting their money into that kind of risk, it should be that there's regulatory oversight. So ICOs to me are one category. I would say cryptocurrencies to me are a little bit different. I think that it would actually be good to hear Brian's point of view, because I would say, digital currencies as they exist today, maybe none of them are the right ones. But the fact of the matter is, I do think we have to accept the idea that just because we can't see it and touch it and feel it doesn't mean it's not something that's societal and that will actually have an impact and, frankly, some sort of utility in society as we go forward. And so this kind of concept of this distributed application serving as a global currency construct is very interesting, and it allows for the freer flow of capital across the world. I think that, Brian, you were talking to me earlier about a lot of concerns around it in terms of the ability to trace it, to be able to make sure that it's done safely, that it's being used for the right reasons, is one of the biggest outstanding issues related to it. So maybe you should.
Well, first on the investment side, we've been clear what we think at the company in terms of our clients and customers, and in terms of staying away from that. But when you go to the actual operational question, which is when you take these things apart, the most sort of important purpose for use of a currency is what Adena said, which is, can I transfer small balances across jurisdictions and not have the tariff be as high in that transfer? Which is, the thought would be then you could open up micro merchants across the world that then could sell earrings from Brazil to here to an individual, and the money could pass and you knew it was good money and it could move without the cost of foreign exchange and things like that. So that's where a lot of this started. And so we in the industry and with the World Economic Forum and some other things have been trying to build a potential solution to that, and it's being tested in some places now, which would be a low balance bank account, which would allow money to move that you wouldn't have to do all the work because it'd be in small balances. Whenever accumulated, you'd find it. And so think of cash in your pocket, just have to be cash on a thing, but it ultimately ends up in it's a bank account. But what you have to do is knock out the requirement that you do all the work. And if you did that, say you could have $500 US equivalent on it at any given time, and anytime it went to somebody else, accumulate it, you would quickly bring in a couple billion people that would never have to go through AML KYC to participate in a bank frictionless payment system. So there's ways you can solve that particular problem. And so that's the legitimate side, which is the relatively high transaction cost to take, to make a payment from US dollars to Brazilian reais across a $25 purchase that the world wants to open up and trade and everything. And that's the legit part. Other than that, there's no need in the US for digital currency. Half the money Bank of America by consumers, which is $400 billion in the first quarter this year, $350 to $400 billion moved digitally. So it's already happening. It's already happened more than half our currency, and that's growing at 14% a year versus non-digital forms. And non-digital includes swiping a credit card at a terminal. That's considered non-digital. So think about that as being a dominant way you transact a debit or credit card. So think about that being taken out and called, same as dollars over the transom. So if you think about that, it's moving, it's growing at 14%. And by the way, we're not different from the peers. You are seeing this money move to more digital form just for the convenience of payments, and the wallets and all the different modes have gone out there are moving this along. But inside the U.S., it's really a question of moving small balances outside the interchange and stuff, which on debit cards is a small amount of money now. So we took that risk out of the system. The debit card changes. So you're really getting the point. You can move a lot of money, a lot of volume of money in small transactions. You have that much tariff. So it's really this cross-border. There's a legitimacy. If I were advising, the Secretary of Treasury, which once in a while I get to, and they listen to me on a very rare occasion, but if I were advising them, I would tell them, and as I've told them, that the idea of anonymous currencies just never turned out to be a good thing. And that's the piece that so there's blockchain and technology we talked about, that there's digitization of cash. At our company, it's $5 billion to move coin currency and check around the company. There's nothing higher interest in us than to get rid of that side. And then there's anonymous. And anonymous, you really have to pay attention to, because that is what we've spent years trying to move out of the system, which is with low denomination dollar bills, 100 being the highest denomination in the U.S., and how we, all the work we've done in anti-money laundering and all that stuff. If you make currencies anonymous in volume, you have a real potential risk from both tax receipts and also just supporting activities. And so the confusion is people put the two together, and they're very separate things. So you can have digital cash that can be attributable and non-anonymous. And so we'll see it through, but I think that's why we've taken a pretty strong position on it. And then the speculation is really for Gary and people like that have spent their lives in Adena making good markets. That to me is really a matter of public policy, which I think people are getting the right place on. But they're really worried about the anonymous cash question.
Mm-hmm. So I heard you say the technology is worth something. It's already probably spurred a little competition, and an important organization like your own. You're trying to do the cross-border more efficiently.
Yeah.
And that the rest of it you don't see much value in, but what you're particularly concerned about is the anonymous nature. And I would agree with you that I think my travels around the globe and talking to some academics and regulators around the globe is there's a pretty big consensus, at least in the regulatory state, that this anonymity is challenging public policy and social goals. And we do have shared social goals to keep our tax base full, and to protect against terrorism finance or other bad types of financing. And so,
but that drifted for a while.
What's that?
That drifted for a while.
Yeah.
And they got there, but it took a while because you had people taking in the direction that forgot the question that was really.
And there'll still be some regulatory arbitrage. I mean, the Prime Minister of Malta said he wants to be the home of all this stuff. So
I know we're almost running out of time here. I don't know if we have time for questions.